Discipline channel. Today, we will discuss long-term investments versus short-term investments. Long-term versus short-term investing. Which one is right for you? This is probably one of the most common questions new investors ask. You see stories of day traders making a fortune overnight. And then you hear about legends like Warren Buffett, who built their wealth slowly and steadily over decades. It can be super confusing. So today, we're going to break it all down. We'll explore the good, the bad, and the ugly of both strategies so you can figure out what truly aligns with your financial goals, your personality, and your lifestyle. By the end of this video, you'll have a much clearer picture of your own path to building wealth. Let's dive right into the fast lane and talk about short-term investing. This is the world of day trading, swing trading, okay? And basically any strategy where you're reholding onto an asset for a year or less, sometimes just for a few minutes. The biggest appeal, speed. The primary benefit is faster access to your capital. Unlike long-term strategies where your money might be locked up for years, short-term trading can generate profits that you can access relatively quickly. If you make a successful trade today, that cash could be in your bank account by next week. This can be incredibly attractive if you're really looking for a more active way to generate income rather than just parking your money somewhere. Another advantage is that there are opportunities in almost any market condition. When the overall market is going up, that's great. But short-term traders can also make money when the market is going down or even just moving sideways. They use strategies like short selling, where they bet on a stock's price falling, or they trade ranges in a flat market. This flexibility means you're not just sitting on your hands waiting for a bull market to resume. You're actively seeking out opportunities created by volatility, which is pretty much always present in the financial markets. For a skilled trader, every market movement is a potential payday. And that brings me to the next point, skill-based returns. Short-term trading is very much a game of skill, okay? Your success isn't just about luck or picking a good company and hoping for the best. It's about your ability to read charts, understand technical indicators, manage risk, and control your emotions. This can be empowering, okay? If you're willing to put in the time to learn and practice, your potential returns are directly tied to your expertise. Unlike a long-term investment, where your returns are heavily influenced by broad market trends, a short-term trader's success is in their own hands, which is a huge draw for many people. But before you rush off to open a trading account, let's talk about the other side of the coin. The reality is, short-term investing is not all sunshine and fast profits. It comes with some serious downsides, and the biggest one is risk. The potential for high returns is directly linked to higher risk and volatility. The same market swings that can make you a quick profit can also hand you a devastating loss just as fast. You could lose a significant portion of your capital in a single day, or even a single trade, if you're not careful. This isn't just a possibility, it's a daily reality for traders. This high-stakes environment isn't for everyone and requires a very strong stomach for risk. This leads us to the emotional and psychological strain, constantly monitoring the markets, making split-second decisions, and dealing with the financial and emotional highs and lows of winning and losing can be incredibly stressful. The pressure is immense. You're fighting against sophisticated algorithms, professional traders, and your own internal biases like fear and greed. This constant battle can lead to burnout, anxiety, and poor decision-making. Many people underestimate the mental fortitude required to be a successful short-term trader. It's a full-time job that can take a serious toll on your mental health. Finally, let's not forget the practical stuff, costs and taxes. Active trading means you're making lots of transactions. Each trade often comes with a commission or fee, and these can add up very quickly, eating into your profits. More importantly, in most countries, profits from investments held for less than a year are taxed as short-term capital gains. These are typically taxed at your ordinary income tax rate, which is almost always higher than the long-term capital gains rate. So, Not only do you have to be successful enough to beat the market, but you also have to make enough profit to cover all your trading fees and a bigger tax bill. Okay, let's shift gears and slow things down. Let's talk about the marathon of investing, the long-term approach. This is the strategy of buying and holding assets like stocks, bonds, or real estate for many years, often decades. The most significant benefit of this approach is the reduction of emotional decision-making. When you're investing for the long haul, you're not worried about today's news or tomorrow's market dip. Your focus is on the big picture, 10, 20, or 30 years down the line. This mindset helps you avoid panic selling during market downturns or getting swept up in speculative bubbles. You simply trust in the long-term growth of your chosen assets and tune out the daily noise. This removes a massive amount of stress from the equation. Another huge plus for long-term investors is lower costs and taxes. Since you're not trading frequently, you're not racking up transaction fees that eat away at your returns. You buy, you hold, and you let it be. Furthermore, when you finally do decide to sell your assets after holding them for more than a year, your profits are typically taxed at the much lower long-term capital gains rate. This is a massive advantage. Over decades, the money you save on taxes and fees can compound and add a substantial amount to your final nest egg. It's a less exciting, but often more effective, path to wealth. Let's be honest, long-term investing is just simpler and more time efficient. For most people, this is the biggest selling point. You don't need to be glued to a screen all day, analyzing complex charts. You can spend a few hours doing solid research to pick good investments like low-cost index funds or solid blue-chip companies. Then, you can pretty much set it and forget it, maybe checking in a few times a year to rebalance. This strategy allows you to focus on your career, your family, and your hobbies, while your money works quietly for you in the background. It's a passive approach that fits seamlessly into a busy life. Of course, no strategy is perfect. Long-term investing has its disadvantages too. The most obvious one is that your capital is tied up for a long time. If you invest a large sum of money into a retirement account or a stock portfolio, you can't just pull it out next month to buy a car or fund a vacation without facing penalties or disrupting your long-term plan. This lack of liquidity can be a drawback for people who might need access to their cash sooner rather than later. Your money is on a long journey, and you have to be patient enough to let it complete that journey. Another challenge is the slow feedback loop. When you make a long-term investment, it might take years or even a decade to know if you made a good decision. Did you pick the right company? Was this the right fund? The answer won't be clear for a very long time. This can be frustrating for people who like to see immediate results from their efforts. With short-term trading, you know if you were right or wrong very quickly. With long-term investing, you're operating on a foundation of faith in historical data, and you need the patience to wait for the story to unfold. And it's crucial to remember that even though it's generally considered safer, long-term investing is not risk-free. Market risk still exists. You could invest in a great company that gets disrupted by new technology. Or you could live through a lost decade where the market goes sideways for 10 years. Major economic downturns can still significantly impact your portfolio's value, and it can take years for it to recover. While time is on your side to ride out these storms, the risk of a prolonged bear market or picking the wrong long-term assets is always there. The phrase, past performance, is not indicative of future results, is one every long-term investor should take to heart. So, where does that leave us? As you can see, there's no single best way to invest. It's not about short-term versus long-term in a fight to the death. It's about finding the right fit for you. Short-term trading offers the allure of fast profits and the thrill of the chase, but it demands immense skill, time, and emotional resilience, and it comes with high risk and high costs. It's best suited for those who are willing to treat it like a full-time job and can stomach the volatility. Long-term investing, on the other hand, is a slower, more methodical path. It leverages the power of compounding and reduces stress and costs. It's ideal for most people who are looking to build wealth for major life goals like retirement without having to become market experts. Ultimately, the best strategy is one that lets you sleep at night. Maybe it's a combination of both. You could have a core portfolio of long-term investments for your retirement and a smaller, separate account for some fun money to try your hand at shorter-term trades. The key is to understand the pros and cons of each. Be honest about your own personality and goals, and then build a plan that you can stick with. Investing is a personal journey, so take the time to find your own path. Thanks for sticking with me through all that. I hope this gave you a clearer understanding of the differences between these two investing philosophies. If you found this video helpful, do me a favor and hit that like button and subscribe for more content just like this. And I'd love to hear from you in the comments. Saw you a long-term investor, a short-term trader, or a little bit of both? Let me know. Thanks for watching, and I'll see you in the next video.